What is up, money makers? Sanjeev here. Now, I got a question, and this is also a question that I've been asked quite often on how would I know the type of portfolio I should have for myself when I'm investing money, right? Now, this is a very, I wouldn't say a touchy subject, but it's also something that you should really sit down with someone who knows what they're doing when you're doing a portfolio of investing, right? But this would just give you a brief understanding of how do you actually design something like this, right? Now, I'm from the unit trust background, so I can only, I guess, best advise based on unit trust and how the unit trust would actually a portfolio based on unit trust, right? So the first and foremost thing, so you want to start investing, how do you go about it? Well, the first ever thing you should know is that you should have at least 3 to 6 months of your savings in the bank. All right, 3 to 6 months of your income saved in the bank. All right, now if you have a very stable job and if you have something that pays you consistently and all that, 3 months should be ideal. If you have a job, or rather a business that is very erratic, 6 months would be the higher side of it, right? Before you even consider investing, this should be kept aside as your I guess it's your emergency fund. All right, so you use this in terms of emergencies, major emergencies, minor emergencies, and also it is used for in the event you are out of a job, right? Temporarily. Now, the next thing is, before you even start investing, and aside from your emergency fund, the other thing you should really do is to put aside regularly a small amount, which is approximately 10% of your income. Just put aside as another form of savings. This form of saving is directly for you to actually access when you don't have money in your emergency fund. All right, so this is a backup of your savings itself. Now, that too considered done, right? How do you decide on what portfolio you should actually go with? This is designed based on many factors. All right, and one of the main factors is your age. Now, why age? Mainly because if you were to think about it, you could consider taking a very high risk portfolio when you are younger, and when I say younger, in your 20s to 30s, in your 30s to 35, right? And the reason for that is because in any event of a major loss, you would be able to recover that funds through your employment or through your business, right? As you start aging towards your 35, 40, 45, you should actually start moving back towards safer investments. So let's cover the investments first. In unit trust, that's basically the safer form of investment is a bond fund, right? And what a bond fund basically is borrowings. Now, a bond fund realistically gives you a returns of somewhere between 3.5 to 4%. All right. Now, this is where, even if you are very young, I would suggest at least 10 to 20% of your investment should be in. All right, if you don't have a bond fund, you could open an FD account, right? And this is where an investment 10 to 20% of your investment should be in when you're young, right? As you move on, you have equity fund. Now, equity fund is basically stocks and shares, and this is where the highest risk versus returns actually comes in, right? So as you know, when you take higher levels of risk, you have higher chances of getting better returns, right? And when you're young as well, it's best to have a big portion of it in equity funds, right? Now, the third type of fund is a REIT, a real estate trust fund, which is not necessarily an equity, but it at times behaves like an equity, meaning it has the fluctuation of an equity fund, right? So we go back to equity and we go back to REIT, and in both of this, if coming back to, if you're young and if you don't need to invest, or rather don't need the money immediately, about 80% of your of your total investment should be in this place. All right, the equity and also a REIT fund. Now, moving on, some of the other factors to really consider, and those are if you're married, if you have kids, and what are your goals. Right, let's talk about marriage and kids first. Now, both of this costs a lot, marriage and kids, right? And it's important to start building your savings, start building a bigger amount of savings when you have both of these factors, right? Now, when you have kids as well, it is a costly affair. So I've been told. I don't have kids, alright, which is why I'm very happy. Anyway, I mean, people with kids also are very happy. Okay, so coming back to it, the last factor is, why are you investing? It is very, very important to understand why you're investing. What is your goal behind this investment? All right, if you have no goal at all, one of the best investment goals is to invest for your retirement. All right, so you backtrack again from how old you are right now to where your retirement is, and you decide on where your retirement is. It could be 55, it could be 60, it could be 65. The reason why we don't bring it forward to 40 and 45 is because the amount of money you would need is significantly more as opposed to retiring at 60 or 65, right? And when you're building a fund for your retirement, the goal behind it is to build a fund that is sufficient to take care of your expenses when you retire. Right? So I've got a lot of clients in their 40s and 50s, and most of the time when we design a portfolio, it's designed to build them and to give them a sustainable income when they actually step out of their employment. All right. So basically saying, the shorter time frame you have moving towards your retirement, the lesser risk you would take. All right. So a general rule of thumb, I would say, is from your 20s to 35 to 40s, depending on your commitments, you would have about 20 to 30% in a bond fund, and the rest of it will be in equity or real estate trust fund, REITs. Right. Now, moving towards your 45, 50, 55, a bigger portion starts going towards the bond fund, right? Because that's where you have stability, and also you don't experience the major swings of the market, right? And when you start doing it in this manner, you will notice very quickly that the bond funds are what offers very strong stability and income, and the equity fund offers you very high growth rates, right? So besides that, what I also urge a lot of young people to do, young meaning before your 30s or even early 30s, is to get an investment property as well. Now, that's an entirely different topic, but generally I've seen many people be very successful when they have an investment property with a target, with a goal, right? So let's do a quick recap. Firstly, your age. This matters a lot. Firstly, it's your savings, 3 months or 6 months of your savings. Secondly is your age. Thirdly is, what is that? Okay, it's your commitments. And fourthly, what is your goal to invest? Why are you investing your money? A little bit more on goals. Some people invest for a short-term goal, and that could be to buy a house in the next 5 years, next 10 years. Some people invest to have a children's education fund. Right? Some people invest for their retirement fund. Some people invest to have a traveling fund, right? So identifying your goals and identifying all these 4 areas will really determine what sort of investment portfolio you should really go into, right? Now, if you're interested to find out how I design portfolios, how me and my team designs portfolios for my clients based on their needs, you can always hit me up at the email down below, right? And if you're interested to find out on how we also remove risks from investment portfolios, definitely do drop me an email, right? So catch up for my next videos. Do like, do subscribe, and do comment down below if you have any other videos that you would like to see. All right, as always, enjoy, have an awesome time, and happy investing, everybody. Peace out.